Forex, or foreign exchange, is the global marketplace for trading currencies. The Forex market is a decentralized market, operating 24 hours a day, 5 days a week. Forex facilitates currency exchange for international trade and investment activities. The Forex market is essential for converting currencies to enable global commerce. Forex trading involves simultaneously buying one currency and selling another. Currency pairs, such as EUR, USD, are traded based on the expectation that one currency's value will increase relative to the other. The relative valuation between two currencies determines the profit or loss in Forex trading. Forex trading is a global, decentralized marketplace for exchanging currencies. Fluctuations in currency values are influenced by various economic and political factors. The primary goal in Forex trading is to capitalize on changes in currency exchange rates. Traders seek to buy a currency at a lower price and subsequently sell it at a higher price to realize a profit. Conversely, traders may sell a currency at a higher price and then buy it back at a lower price. Profit is generated from the difference between the buying and selling prices of the currency. In Forex trading, a pip represents the smallest standardized price increment for a currency pair. For most currency pairs, a pip is equivalent to 0.00001. Understanding pips is essential for traders to accurately calculate potential profits or losses. Fluctuations in pips directly impact the financial outcome of Forex trades. In Forex trading, a lot represents a standardized unit of currency. Standard lots, mini lots, and micro lots define different trading volumes. Trading volume directly impacts the potential risk and reward in Forex trading. A standard lot typically consists of 100 units of the base currency. Mini lots and micro lots offer smaller trading volumes, reducing the capital required. Selecting the appropriate lot size is crucial for managing risk and optimizing trading strategies. Leverage enables traders to manage larger positions using a smaller capital base. Leverage can magnify potential profits significantly. Increased leverage also substantially elevates the risk of losses. The potential for both amplified gains and losses should be carefully considered when using leverage. The spread is the difference between the ask, buying, and bid selling prices of a currency pair. The ask price represents the price at which a trader can buy the base currency. The bid price represents the price at which a trader can sell the base currency. The spread represents the broker's commission for facilitating the trade. Selecting a reputable and regulated Forex broker is essential for protecting capital. Reputable brokers are licensed by recognized financial authorities. Regulation ensure fair trading practices. Choosing a regulated broker mitigates risks associated with unregulated entities. Licensed brokers adhere to strict financial standards and reporting requirements. A user-friendly trading platform is essential for effective Forex trading. Chart analysis tools enable traders to identify trends and make informed decisions. Efficient order placement functionality allows for quick execution of trades. Comprehensive account management features provide traders with a clear overview of their positions and performance. Essential tools integrated within the platform streamline the trading process. Demo accounts simulate real trading environments using virtual funds. These accounts allow beginners to practice trading strategies without risking actual capital. Demo accounts provide a safe space to learn market dynamics and trading mechanics. Beginners can experiment with different asset classes and trading tools in a controlled environment. Demo accounts help build confidence and familiarity with trading platforms before engaging in live trading. A demo account offers a risk-free environment for learning Forex trading. Demo accounts allow traders to test various strategies without financial risk. Using a demo account helps build confidence before trading with real money. Intricacies of Forex trading can be safely explored using a demo account. Demo accounts simulate real-world trading conditions, providing practical experience. Support and resistance levels represent specific price points on a financial chart. At support levels, the price tends to bounce upwards, indicating buying pressure. At resistance levels, the price tends to bounce downwards, indicating selling pressure. Support levels can be used to identify potential entry points for buying. Resistance levels can be used to identify potential exit points for selling. Identifying support and resistance levels aids in making informed trading decisions. Trend identification involves analyzing price charts to determine the market's overall direction. Uptrends are characterized by a series of higher highs and higher lows, indicating a bullish market. Downtrends consist of lower highs and lower lows, signaling a bearish market sentiment. Sideways trends or consolidations show prices fluctuating within a range, indicating market indecision. Each trend type presents distinct trading opportunities and requires different strategies. Accurate trend identification is crucial for making informed trading decisions and managing risk effectively. Technical indicators provide insights into price, momentum, volatility, and potential trend reversals. Moving averages are used to smooth out price data and identify the direction of a trend. The Relative Strength Index, RSI, measures the magnitude of recent price changes to evaluate overbought or oversold conditions. Starting with a few simple indicators allows for a gradual learning process. Learning more indicators enhances the ability to interpret market dynamics. Risk management involves strategies designed to protect trading capital. Setting stop-loss orders is a crucial practice in risk management. Limiting the amount of capital risked per trade is essential for preserving capital. Effective risk management aims to minimize potential financial losses. Implementing risk management strategies enhances the stability of trading portfolios. A stop-loss order is designed to automatically close a trade. This order is triggered when the price reaches a predetermined level. The primary function of a stop-loss order is to limit potential losses. Stop-loss orders activate when the market moves against the trader's position. By closing the trade automatically, stop-loss orders prevent further financial decline. Limiting risk to 1–2% of trading capital per trade mitigates the impact of individual losses. Adhering to a small risk percentage helps traders withstand losing streaks without depleting their capital. Consistent risk management prevents significant capital erosion from a single unfavorable trade. Maintaining a low risk percentage allows for a greater number of trades and increased opportunities for profit. Effective risk management is crucial for long-term trading success and capital preservation. Live trading should only commence after demonstrating consistent profitability in a demo account. A solid understanding of risk management principles is crucial before transitioning to live trading. Demo accounts provide a safe environment to practice trading strategies without risking real capital. Consistent profitability in a demo account indicates readiness for the challenges of live trading. Risk management includes setting stop-loss orders to limit potential losses on trades. Transitioning to live trading without adequate preparation can lead to significant financial losses. Begin live trading with small position sizes to minimize potential financial losses. Gradually increase position sizes as confidence in trading strategies grows. Profitability should be a key factor in determining when to increase position sizes. Consistent profitability validates the effectiveness of the trading strategy. Small initial positions allow for learning and adaptation without significant financial risk. Maintaining a trading journal aids in tracking trading performance. Trading journals help identify both strengths and weaknesses in trading strategies. Learning from both winning and losing trades is facilitated through journaling. A trading journal provides a structured approach to improving trading skills over time. Emotional discipline is essential for avoiding impulsive decisions influenced by fear or greed. Adhering to a predefined trading plan is a key component of emotional discipline. Chasing losses often leads to further emotional and financial distress. Emotional regulation techniques can help maintain a rational mindset during volatile market conditions. Consistent emotional discipline improves long-term trading performance and reduces risk. Consistent market analysis requires staying informed on economic news. Geopolitical events significantly impact currency prices and market stability. Various factors can influence currency prices, necessitating continuous monitoring. Comprehensive market analysis involves tracking a wide range of global factors. The Forex market is constantly evolving, necessitating continuous learning for traders. Staying updated on new strategies is crucial for adapting to market changes. Monitoring new tools enhances a trader's ability to analyze and execute trades effectively. Reputable sources provide essential insights into current market trends and emerging opportunities. Success in Forex trading demands patience, persistence, and a long-term perspective. Avoid get-rich-quick schemes. Sustainable strategies are essential for consistent profitability. Building a robust trading strategy requires a methodical and disciplined approach. Long-term success in Forex trading is achieved through continuous learning and adaptation. Effective risk management is crucial for protecting capital and ensuring long-term viability. A long-term perspective allows traders to weather short-term market fluctuations and capitalize on long-term trends. A comprehensive trading plan includes defined goals, strategies, risk management, and market analysis. Adhering to a trading plan helps avoid emotionally driven deviations. Consistent execution of a trading plan is crucial for achieving set objectives. A well-structured trading plan serves as a roadmap for navigating market complexities. Effective risk management is an integral component of a successful trading plan.